Welcome to XRP On Moon, the place where we break down the most explosive XRP news, hidden signals, and market narratives shaping the future of digital finance. And today, what you are about to hear is not just another prediction or casual speculation, because this is centered around a concept that has started circulating across high-level crypto discussions known as the market multiplier, a theory that suggests XRP is not just moving with normal market cycles anymore, but may be entering a phase where liquidity expansion, institutional positioning, and macro-driven demand could combine in a way that dramatically accelerates price discovery far beyond what most retail traders are currently prepared for. And before you dismiss this as another overhyped crypto story, understand that the reason this idea is gaining attention is because it ties together several ongoing developments in the financial system, from cross-border settlement adoption narratives to liquidity migration from traditional assets into blockchain-based rails. And in the center of this entire conversation stands XRP, a digital asset that has always been controversial, always debated, but consistently present in discussions involving real-world financial infrastructure. Now, the reason people are suddenly talking about a possible $100 XRP scenario is not because of random hype, but because of how exponential market mechanics behave when liquidity conditions shift. And according to proponents of this market multiplier concept, the price of XRP would not rise in a linear fashion, but instead could experience accelerated valuation jumps if certain thresholds are crossed, especially if institutional capital begins to treat XRP not just as a speculative asset, but as a functional bridge asset within global payment flows. And while this sounds extreme at first hearing, we have to understand that markets are not driven purely by sentiment. They are driven by liquidity, utility, and positioning. And when those three forces begin to align in a concentrated way, the result is often what analysts refer to as a repricing event, where previous resistance levels become irrelevant because new demand structures emerge. To understand why this theory is gaining traction, we need to step back and look at XRP's unique positioning in the crypto ecosystem. Because unlike many digital assets that rely primarily on retail-driven speculation, XRP has always been associated with settlement efficiency, liquidity provisioning, and cross-border transfer optimization. And even though regulatory uncertainty has historically clouded its growth narrative, the underlying technological proposition has never disappeared. And now, as global financial institutions continue exploring blockchain-based settlement layers, the idea that a liquidity-efficient digital asset could play a central role becomes more relevant. And this is where the multiplier effect argument begins to form, suggesting that if XRP is integrated into even a fraction of global payment corridors, the demand pressure created by transaction utility alone could theoretically exceed current circulating liquidity assumptions. However, what makes this conversation even more intense is the psychological layer of market behavior, because when traders hear numbers like $100 per XRP, the immediate reaction is disbelief. But in financial history, we have seen multiple assets undergo radical repricing when narrative shifts align with actual adoption curves, and the market multiplier theory essentially claims that XRP could be entering such a narrative phase where speculation, utility, and institutional accumulation overlap, creating a feedback loop where rising price attracts more attention, which attracts more liquidity, which further accelerates price movement, and this is where things become exponential rather than incremental. At this stage of the discussion, it is important to stay grounded, because while the theory sounds compelling, markets do not move on theory alone. They move on execution, timing, and real-world adoption. And even though there are signals of increasing institutional curiosity and infrastructure readiness, there is still a significant gap between theoretical models and actual global deployment at scale. Meaning that while the idea of XRP reaching extreme valuations under a multiplier scenario is mathematically interesting, it remains heavily dependent on real adoption milestones that are not guaranteed. Market multiplier discussion begins when we stop treating XRP as just another crypto chart and start analyzing it through the lens of global liquidity movement. Because in traditional markets, price does not simply rise due to demand alone. It rises when liquidity enters at scale and stays persistent across multiple layers of adoption. And this is where the argument around XRP becomes more complex and more interesting at the same time, because its potential role is not limited to retail speculation or exchange trading, but is instead tied to a deeper financial function that involves settlement, bridging value across currencies, and potentially acting as a neutral liquidity layer in cross-border transactions. Now, the so-called multiplier effect theory suggests that if XRP becomes embedded even partially into institutional payment corridors, the impact on its valuation would not be proportional but exponential, meaning that small increases in usage could theoretically create disproportionately large increases in demand for available supply. And this is where supply mechanics begin to matter significantly because XRP has a fixed maximum supply structure. And unlike fiat currencies that can expand through monetary policy, its circulating availability is constrained by predefined issuance rules, which means that in a high-demand scenario, the price discovery process becomes more aggressive because there is no infinite dilution mechanism to absorb demand spikes. However, what most people misunderstand at this stage is that institutional adoption does not mean immediate retail visible price movement, because in early phases of infrastructure integration, liquidity is often absorbed quietly through over-the-counter channels, private agreements, and settlement-level usage that does not instantly reflect on public order books. And this is why many analysts argue that when real institutional flows begin, the visible price reaction often lags behind the actual utility being deployed, creating a delayed but potentially explosive adjustment phase. Once market participants realize that supply available on exchanges is not representative of true circulating demand. This is where the psychological component of the market multiplier becomes extremely important because financial markets are not just mathematical systems, they are also belief systems. And when traders begin to collectively believe that an asset has entered a new functional category, such as being a core settlement bridge rather than just a speculative token, then valuation models begin to change rapidly, and this shift in perception can often accelerate capital inflows far faster than fundamental data alone would justify in normal conditions. At the same time, it is necessary to understand that the road to such a scenario is not linear or guaranteed, because even if XRP's technology is positioned for efficiency, adoption depends on regulatory clarity, banking integration willingness, global compliance frameworks, and the readiness of existing financial systems to transition or partially integrate blockchain-based settlement layers. And each of these factors introduces friction that can slow down or delay the kind of exponential adoption curve that the multiplier theory assumes. Still, what keeps this narrative alive in crypto discussions is the idea of liquidity compression, where increasing usage across corridors gradually reduces available free-floating supply. And if demand continues to expand while accessible liquidity becomes tighter, the market does not adjust gradually, but instead tends to reprice aggressively in short-time windows, which is where extreme predictions like $100 XRP are derived from, not as a linear forecast, but as a scenario outcome under specific high adoption, low liquidity conditions. The focus shifts from theoretical demand models into the more critical and often overlooked layer of institutional behavior, because no matter how powerful a narrative like the market multiplier sounds on paper, the real force that determines whether an asset can actually experience exponential growth is how large-scale capital allocates itself in stages, quietly, strategically, and often long before the public ever realizes what is happening. And this is where XRP's position becomes especially interesting because, unlike purely retail-driven assets, XRP has always been surrounded by discussions involving banks, payment corridors, and liquidity infrastructure, which means any meaningful price expansion scenario must be examined through the lens of institutional accumulation patterns rather than emotional retail cycles. Now, in traditional financial markets, when institutions prepare for long-term positioning, they rarely enter in a way that creates immediate visible spikes. Instead, they use layered entry strategies, OTC liquidity channels, and time-distributed accumulation to avoid slippage and market disruption. And if we apply the same logic to XRP under the market multiplier theory, then the first phase of any major expansion would not actually look like a dramatic price surge, but rather a long period of silent positioning where supply is gradually absorbed without triggering panic or euphoria in the broader market. And this is the stage where most retail participants often misinterpret price stability as lack of interest, when in reality it can sometimes represent the exact opposite. The second layer of this concept involves liquidity corridors, because XRP's value proposition has always been tied to its ability to act as a bridge asset between different fiat currencies and settlement systems. And if even partial integration into global payment networks were to occur, the effect would not simply be increased trading volume, but a structural demand for liquidity provisioning across multiple jurisdictions. And this is where the multiplier effect becomes more complex, because it is not just about how many people are buying XRP, but about how often it is being required to facilitate value transfer in real-time financial systems, which introduces a usage-driven demand model rather than a speculation-driven one. At this point, it is also important to understand that institutional capital does not think in terms of retail price targets like $10 or $100 in isolation. Instead, it evaluates assets based on utility efficiency, settlement speed, regulatory compatibility, and liquidity depth. And if an asset begins to demonstrate dominance in even one of these categories at scale, then valuation can shift rapidly as capital reallocates from less efficient systems into more efficient ones. And this is where proponents of the market multiplier theory argue that XRP could theoretically experience a revaluation phase if it becomes structurally embedded in cross-border liquidity networks. However, what makes this scenario controversial is that it assumes a level of adoption that is not yet fully visible in public data, which means the entire argument rests partially on forward-looking assumptions about integration timelines, regulatory evolution, and global banking willingness to adopt blockchain settlement layers. And in financial reality, these processes are slow, heavily regulated, and subject to geopolitical and economic constraints that can delay even the most promising technologies for years before they reach meaningful scale. Still, markets often move ahead of full realization because pricing is a forward-looking mechanism, and once enough participants begin to believe that structural adoption is inevitable, capital starts positioning early, which creates price pressure before actual utility peaks. And this is where the psychological reinforcement loop begins, because rising prices attract more attention. Attention attracts more capital, and capital accelerates the very narrative that justified the movement in the first place. It becomes increasingly important to separate emotional excitement from structural market mechanics, because while the idea of a market multiplier sending XRP toward extreme valuations captures attention very quickly, the real question that serious analysts focus on is not whether a high price is imaginable, but under what exact conditions such a repricing event could realistically occur. And history shows that when assets experience exponential moves, it is never because of a single catalyst, but rather because multiple systemic forces converge at the same time in a way that overwhelms normal market equilibrium. One of the most important of these forces is liquidity shock dynamics, which occur when available supply in open markets becomes insufficient to satisfy sudden or sustained demand pressure, and this does not always require mass retail buying. In fact, in many historical cases, the most powerful liquidity shocks have been triggered by institutional repositioning or structural demand changes that are not immediately visible to the public. And when such shifts begin, price does not rise gradually in a smooth curve, but instead moves in bursts, gaps, and rapid expansions as the order book struggles to maintain balance between buyers and sellers. Now, if we apply this framework to XRP under the multiplier concept, the argument becomes that if XRP transitions from a primarily speculative asset into a functional settlement liquidity tool, then demand would no longer be optional or sentiment-driven, but structurally required in certain transaction flows. And this is a very different kind of demand because it is continuous, operational, and linked to real-world financial activity, meaning that even small increases in usage frequency could translate into persistent buy pressure that does not easily dissipate during market downturns. At the same time, market cycles also play a crucial role in determining whether such pressure can actually translate into sustained upward movement, because in every major asset class, there are phases of accumulation, expansion, distribution, and contraction, and assets that eventually experience parabolic growth usually go through a long accumulation phase where price appears stagnant or range-bound while underlying positioning quietly builds, followed by a sudden expansion phase where market perception shifts rapidly and previously ignored fundamentals suddenly become central to valuation narratives. This is where the psychological aspect becomes extremely powerful, because once a critical mass of participants begins to believe that XRP is no longer just a speculative token, but a core component of future financial infrastructure, then valuation models begin to adjust aggressively and expectations themselves begin to influence price action, which creates a self-reinforcing cycle where belief and liquidity interact continuously, accelerating momentum beyond what traditional valuation frameworks would normally predict. However, it is equally important to emphasize that such cycles do not guarantee upside without interruption, because volatility remains an inherent feature of crypto markets, and even in strong structural trends, deep corrections, liquidity resets, and sentiment-driven pullbacks are common, especially when leverage and speculation enter the system at high intensity, which means that even if a broader upward repricing narrative is forming, it would likely unfold in waves rather than a straight vertical trajectory. This is also where timing becomes one of the most misunderstood elements of these discussions. Because even if the long-term thesis is correct, markets often take far longer to reach equilibrium than participants expect, and many strong narratives lose momentum temporarily simply because the market needs time to absorb new information, build infrastructure, and align real-world adoption with financial pricing structures. So when we talk about the possibility of XRP entering a multiplier-driven expansion phase, what we are really discussing is a scenario where structural adoption, liquidity constraints, institutional behavior, and market psychology all begin to align in a way that creates nonlinear price movement, but the key uncertainty remains not the direction of that movement, but the timing, intensity. Everything comes back to one central question that has been driving this entire discussion around the so-called market multiplier and the extreme $100 XRP scenario. And that question is not simply whether XRP can rise, but whether the underlying global financial environment could ever realistically support a valuation shift of that magnitude under conditions of structural adoption, liquidity compression, and institutional integration, because at this level of analysis, we are no longer talking about short-term price speculation, but about the potential reclassification of an asset's role within the global monetary flow system. If we assume, even hypothetically, that XRP becomes deeply integrated into cross-border settlement systems or liquidity routing mechanisms, then its valuation would no longer be determined purely by speculative trading volume, but by transactional demand pressure. And in such a model, the key variable is not just how many tokens exist, but how frequently those tokens are required to move value across networks. Because in high-frequency settlement environments, even small friction reductions or efficiency gains can create massive aggregate demand over time, especially when scaled across global financial corridors. However, it is equally critical to ground this discussion in reality, because even the most advanced technologies do not achieve instant global penetration. And financial infrastructure, especially at the level of banking and sovereign systems, evolves through gradual integration rather than sudden replacement, meaning that even if XRP or similar assets are positioned for utility, the transition from potential to actual large-scale usage is typically measured in years or even decades, not weeks or months, and this naturally limits how quickly any theoretical multiplier effect could actually manifest in market price. At the same time, market psychology plays a decisive role in how these transitions are priced in advance because crypto markets are forward-looking by nature, and participants often attempt to anticipate future adoption rather than waiting for it to fully materialize, which is why narratives can sometimes outpace fundamentals, creating sharp speculative cycles that temporarily detach price from underlying utility before eventually realigning as real-world adoption catches up with expectations. This is where the concept of the market multiplier becomes more of a narrative framework than a guaranteed forecast, because it attempts to describe a scenario in which multiple powerful forces, liquidity tightening, institutional participation, utility expansion, and psychological momentum all converge at the same time, producing nonlinear price behavior that cannot be easily explained through traditional linear models. And while such scenarios have occurred in various asset classes throughout financial history, they are always rare, highly conditional, and heavily dependent on timing alignment between macro and micro forces. So what does all of this actually mean for XRP holders and market observers? It means that the most realistic approach is not to anchor expectations to a fixed price target like $100 as an inevitable outcome, but rather to understand the broader conditions that would need to exist for such extreme valuations to even become theoretically possible, and those conditions include sustained institutional demand, real-world utility integration, reduced friction in regulatory environments, and a consistent long-term expansion of liquidity channels that connect digital assets to global financial systems. Without those conditions aligning, any extreme valuation scenario remains speculative, but with them partially aligning over time, XRP could still experience significant repricing phases that reflect its evolving role in financial infrastructure, even if those movements do not follow a straight or predictable path. And this is why disciplined analysis always focuses more on structure and probability than on isolated price predictions. And finally, it is important to end this discussion with clarity and responsibility, because while narratives like XRP to 100 are powerful and engaging, they should always be viewed through the lens of risk, uncertainty, and market volatility, and not as guaranteed financial outcomes, because all digital assets carry significant risk and can experience rapid and unpredictable price changes in both directions. This video is for informational and educational purposes only and does not constitute financial, investment, or trading advice. Cryptocurrency markets are highly volatile and risky. Always do your own research and consult a qualified financial advisor before making any investment decisions.